Money is part of our daily lives. But have you ever wondered what gives it value? A dollar bill is just paper, and a digital balance is just numbers on a screen. So why do people work hard to earn it and trust it in every transaction? Money powers businesses, pays workers, and keeps goods and services moving every day. Behind every payment is a much bigger financial system, connecting people, businesses, and governments. In this video, we'll uncover how money works and why it shapes the world around us. Let's begin our journey into the fascinating world of money, economics, and modern finance. Why isn't $1 equal to £1 or £1? Every country creates its own currency to support its economy and financial system. The value of money is not the paper or symbol, but what that money can buy. A currency becomes stronger when people trust the economy behind it. When a country grows, produces more, and attracts investment, demand for its currency rises. When confidence falls, people lose trust, and the currency can become weaker. Too much money in circulation can reduce its value and create inflation pressure. A currency's strength reflects the health, stability, and trust of its economy. Currency value is not random, it represents confidence in the country behind it. $1, £1, and £1 are different because their economies are different. Exchange rates constantly change because currencies are traded like products in a global marketplace. Like anything else, a currency becomes more valuable when more people want it. Investors buy currencies from strong economies, increasing demand and pushing values higher. Growing economies usually attract more investment, which can strengthen their currency. When countries buy and sell goods, they create demand for each other's currencies. If America buys more Japanese products, companies need yen to complete those payments. Every currency competes based on economic performance, trade, and global confidence. Interest rates, political events, and economic news can quickly change currency values. Currency markets constantly react as millions of people make financial decisions worldwide. Exchange rates change because currencies reflect the changing strength of global economies. Almost every major country has debt, but who do governments actually owe money to? Governments borrow money to build infrastructure, fund services, and support their economies. Instead of printing money, governments often raise funds by selling bonds to investors. A bond is a promise that the government will repay borrowed money with interest. Banks, investors, pension funds, and even other countries buy government bonds. A country's debt is usually divided among millions of people and organizations. Countries lend to each other because government bonds are considered important investments. Governments usually replace old debt with new debt instead of paying everything off at once. Debt becomes a problem when people lose confidence in a government's ability to repay. A country cannot be treated like a person because its economy continues generating income. As long as investors trust the economy, governments can continue borrowing and managing debt. Debt is not always a weakness. It is a financial tool that depends on how it is managed. If governments can print money, why don't they simply print more to solve every problem? Money only has value when it represents real goods, services, and productive work. Imagine 100 people sharing 100 loaves of bread. Supply and demand stay balanced. Now imagine everyone suddenly receives much more money, but the amount of bread stays the same. With more money competing for the same products, prices begin to rise. This rise in prices is called inflation, reducing the purchasing power of your money. Creating more money doesn't create more food, homes, factories, or valuable resources. History shows that excessive money printing can cause prices to spiral out of control. A healthy economy grows by producing more goods and services, not just more money. When people lose confidence in a currency, its value can quickly begin to fall. You can't print wealth. Lasting prosperity comes from productivity, innovation, and economic growth. Inflation is the gradual rise in prices, causing your money to buy less over time. As prices increase, the same amount of money buys fewer goods and services. When more money competes for the same products, businesses often raise their prices. Strong demand combined with limited supply can drive prices up across the economy. When wages, materials, or transportation become more expensive, businesses may increase prices. You may notice inflation when groceries, fuel, rent, or everyday essentials become more expensive. Families, businesses, and governments all feel the impact of rising prices. A small amount of inflation is common in a healthy, growing economy. When inflation rises too quickly, people's purchasing power can fall much faster. Central banks use tools like interest rates to help keep inflation under control. Inflation reminds us that money's value depends on what it can actually buy, not just the number printed on it. Deflation happens when prices fall across the economy instead of rising. At first, cheaper groceries, cars, and homes might seem like good news. If prices keep falling, many people delay purchases, expecting even better deals later. As consumers spend less, businesses experience fewer sales and lower revenue. To survive, companies may reduce production, cut expenses, or lay off workers. With fewer jobs and lower incomes, households spend even less money. Less spending leads to lower prices, creating a cycle that slows the entire economy. During deflation, debts stay the same while business income and wages may decline. Japan experienced a long period of weak prices and slow economic growth during the 1990s. A stable economy usually benefits from low, steady inflation rather than persistent falling prices. Deflation may sound appealing, but prolonged falling prices can slow growth and weaken the economy. A tariff is a tax that a government places on imported goods. Many people think foreign countries pay tariffs, but that is not how they work. An importing company buys products from another country and brings them across the border. When the goods arrive, the importing company pays the tariff to its own government. The tariff increases the company's cost of importing those products. To recover those extra costs, many businesses increase the prices they charge customers. Eventually, shoppers may pay more for products made with imported materials or goods. Tariffs can also make locally produced goods more competitive against imported alternatives. While tariffs may support domestic industries, they can also lead to higher prices for consumers. Tariffs are taxes on imports, and their costs often ripple through the economy before reaching consumers. Why has buying a home become so much harder than it was decades ago? In many places, home prices have increased much faster than average incomes. For many families, wages have not grown quickly enough to match rising housing costs. When fewer new homes are built, buyers compete for a limited number of properties. As populations grow, more people need housing, increasing demand even further. Some homes are purchased as investments instead of places for families to live. Lower borrowing costs can encourage more buyers, pushing home prices even higher. When buyers can borrow more money, sellers may raise asking prices. Many first-time buyers now spend years saving for a down payment. Homes provide shelter, but they can also become valuable long-term investments. Housing prices are shaped by supply, demand, financing, and the broader economy working together. Trading and investing both involve buying assets, but they follow very different strategies. Trading focuses on short-term price movements to earn profits from market changes. Traders closely watch market charts and make quick buying and selling decisions. Investing means buying quality assets and holding them for many years. Investors focus on business growth, earnings, and long-term value instead of daily price swings. When markets fall, traders may react quickly, while long-term investors often stay patient. Over time, reinvested earnings and compound growth can significantly increase an investment's value. Trading requires speed and discipline, while investing rewards patience and consistent research. The best approach depends on your goals, risk tolerance, and personal investing style. Trading focuses on the next market move, while investing focuses on building wealth over time. Most people see debt as a burden, but when used carefully, it can also be a financial tool. Some investors borrow money using valuable assets as collateral instead of selling those assets. Selling an investment may trigger taxes, while borrowing lets you keep ownership of the asset. Borrowed money can be used to purchase businesses, real estate, or other income-producing assets. If an investment grows faster than the loan costs, borrowing can increase potential returns. But leverage works both ways. If investments lose value, losses can grow more quickly too. Strong collateral and a solid financial position can help borrowers qualify for lower interest rates. Debt itself is neither good nor bad. What matters is how responsibly and wisely it is used. Bitcoin is a digital currency that exists online without physical coins or paper money. Unlike traditional money, Bitcoin operates without being controlled by a single government or bank. Every Bitcoin transaction is recorded on a blockchain, a public digital ledger shared across the network. When you send Bitcoin, computers verify the transaction before it is permanently recorded. Specialized computers help verify transactions and secure the Bitcoin network through mining. Transactions are publicly visible, but users are identified by wallet addresses instead of names. Bitcoin's code limits its total supply to 21 million coins, making it digitally scarce. Because of its limited supply, many people compare Bitcoin to digital gold. Bitcoin offers global access and transparency, but it also comes with price volatility and risks. Whether Bitcoin becomes everyday money or remains a digital asset, its impact on finance is undeniable. Money laundering is the process of disguising illegally obtained money to make it appear legitimate. Financial institutions require information about where money comes from to help prevent financial crime. Experts often describe money laundering as a process with three broad stages. The first stage involves introducing illegal funds into the financial system. The second stage attempts to make the origin of funds more difficult to trace. In the final stage, the funds appear to come from seemingly legitimate sources. Banks and regulators monitor transactions and investigate suspicious financial activity. Preventing money laundering helps protect businesses, financial systems, and public trust around the world. Now let's connect everything we've learned into one complete financial system. People earn money, spend it, save it, and invest it, creating a continuous cycle. Businesses create products, hire workers, and help economies grow through production and innovation. Governments collect taxes to help fund roads, schools, hospitals, and other public services. Banks help move money from savers to borrowers, supporting investment and economic activity. Countries exchange goods, services, and currencies through an interconnected global marketplace. Trust is the foundation that allows money, banks, businesses, and markets to function every day. When you understand how these pieces connect, the financial world becomes much easier to understand. You've completed an incredible journey through the world of money, economics, and modern finance. Remember, money itself has no magic. Its value comes from trust, productivity, and economic activity. The more you understand how money works, the better financial decisions you can make. Finance is always evolving, so stay curious and continue learning throughout your life. Start with small, consistent financial habits today and let them grow into lasting success. If you enjoyed this video, please like, subscribe, and share it with someone who wants to understand money better. Thanks for watching.